Let me get started with this GTV chart on the Bloomberg because it's showing worldwide earnings revisions under pressure right now. This would be the global measure of analyst upgrades minus downgrades of profit expectations plummeting toward negative territory after hitting that all-time high in May. And we continue to hear that even despite this revision, some people saying that earnings estimates are too high. What are you expecting this season?
It's a great question, Sherry, and thanks for having me in the studio. We do think that earnings have been on really a rising trend right since the beginning of the pandemic, actually. And investors may have gotten a little complacent in expecting that trend would continue indefinitely. Having been a sell-side analyst myself, I know that sell-side analysts are guilty quite often of being a little bit optimistic on earnings expectations. And you know, the typical earnings revision ratio of upgrades to downgrades tends to be about 0.8 to 0.9. And we're still above 1, so this is still actually elevated relative to longer-term history. But you know, we actually think the market has been too focused from the inflation debate on the P part of the PE ratio, and we think that the E is actually meaningfully more important. The third quarter earnings that we're about to see over the next month or so around the world really will tell us a lot about the shape of this inflation debate and how it's affecting corporate earnings from a bottom-up basis.
So in the meantime, then, are we headed towards more volatility, and how do you hedge?
Well, that's another great question. We do think if earnings came in exactly as currently forecast, with no upsides or beats, the market would clearly see that as a disappointment. We would recommend investors, though, focus, because E is really coming into the spotlight, on companies where you really feel you can underwrite those earnings numbers. And in an inflationary world, you really need pricing power. And that's really why we would suggest that investors stick to a middle course between valuation and price discipline on the one hand, but also earnings underwritability, if we can use that word, on the other. And we would recommend investors stay defensive and also be global in their investment stance, especially focused on developed markets.
I want to take you to our question of the day. Of course, we've seen this volatility across the tech sector, in particular the FANGs in the US, drive much of the price action over the past few days or so. As we get into tech earnings, particularly Samsung and the semiconductor piece there, how do you expect Asia tech earnings that could potentially move broader assets, and what will you be watching for?
Well, I think some of the semiconductor companies will continue to report pretty strong numbers. We've all heard about the shortages around the world in a variety of different end markets and use cases for the semis industry. The question is actually for the likes of some of the Korean semiconductor giants, how much of a valuation multiple do you put on those earnings? And you know, when can we expect those earnings to peak over the near term? They're obviously great companies over a longer term basis, but this tends to be at the part of the cycle, having been a semis analyst myself, where you start to see the multiples start to compress even as the earnings keep rising.